Hello there. This is Bruce at Fleet Capital Management. It's Friday afternoon, the third day of January 2025. Market is closed, and we are going to take a look at the market. But in today's video, I'm going to introduce you to some fairly significant changes I'm going to make to our stock selection and allocation that I think you will like a lot. So bear with me on that. Let's start. Actually, we'll start back here at the slides. And I always need to say that the video presentation is intended for educational purposes only. The discussion of any security is not a recommendation to purchase or sell the security. As you know, I'm always available to you, Bruce at fleetcapitalmanagement.com. So we're going to make a change to stock selection and allocation. Bear with me, like I said, you'll understand all of this in just a moment. I'm going to show you my screening processes that I have been working on over the last year, and they are showing really tremendous success. So this is a reason that I'm going to be making a change. I have always felt that stocks have to be perfect. The technical analysis has to be perfect. The fundamental analysis has to be perfect. And I think striving for that level of perfection has actually cost us some money. So that's going to be loosened up. Not a lot, but we're still buying the best stocks out there. But perfection is no longer going to be really the litmus test. We're also going to buy a larger number of stocks with a lower percentage allocation. Generally speaking, and I'm talking about accounts in groups 1 and 2 that really buy the stocks, I have always purchased 5% of your account value in each stock. I'm going to lower that probably to 3% because we're going to have a significantly larger number of stocks. So we'll start with a 3% level. And what that does is it lowers our individual security risk. Think about it. If one stock doesn't work and has a loss, well, now we don't have 5% of our portfolio in that. We have only 3% of our portfolio in that. So I think by doing this, larger number of stocks, lower allocation, we will actually be lowering our risk. And another thing is we will not buy any new stocks if we're in a correction. That is a change because previous to this change, it was we will buy no stocks even in a pullback. But after doing a significant amount of research, I've realized that buying stocks in a pullback in an otherwise strong bull market can actually add to our returns. And I'm not talking about small amounts of add. I'm talking about significant amounts of add to our return. So I'm going to show you all of this in just a moment. I'm also making a change to our stop management system. Instead of putting our stops in the market, meaning live, and that means if the stock price goes down, touches our stock, we're out. What's going to happen is I have set an alert on all of my stops, and it's an end of day alert, which stands right here, end of day. And if an alert triggers, I will then put a 1% live stop into the market. I'll show you what all of this means in just a second. But I think these two changes are, well, I should say it this way. I think these two changes have the potential to significantly add to our rates of return while not adding much, if any, additional risk. As a matter of fact, I believe it will be lowering our risk. So it is still true that the single most important thing to know is whether the market's going up or down, and everything follows from there. So we're going to take a look at that first. December was not a great month. I mean, going all the way back to the 10th, where it started in mixed, it just has been a sloppy month. It wasn't the typical December, what do they call it? Santa Claus rally. We didn't get that this year. Okay, you get it most years. We didn't get it this year. And on our dailies, we're still in the red, but they're getting stronger. They're getting better. On the weeklies, we're in a green and a mixed, but it's getting better. And I'm going to show you this on the chart. Our daily MAs are still in what's called a pullback situation, not a correction. And our bear market avoidance is still fine. And our risk fear index, or VIX, is fine. It's kind of perfect. Okay, so let's take a look first at the S&P 500. On the left is the daily, on the right is the weekly. Let's start on the right. On the right, the blue line is the 10-week moving average, and the gold line is the 20-week moving average. When the blue is above the gold, we are not in a bear market. If they cross, we are. And that could be just for a day or a week or a year, but it's a real clear indication that something may be going wrong. Okay, but other than that, we're clearly in this uptrending channel. If you look at these white lines, these are trend lines. We've got this beautiful uptrending channel, and I don't see anything really breaking that. We have lost some momentum down here, which is reflected here. Remember, each one of these bars or candles is a week. When we come to our volume, that green wave is average volume, and our average volume is still on the buy side. So, nothing, it doesn't look as strong as I would like, but these pullbacks happen, and they happen all the time. So that's regular, and I think we will continue in that uptrend. If we go over to here to the left side, which is the daily chart, the white line is our 3-day moving average. We use that to signify a pullback, and pullbacks happen. Here's a pullback that happens all the time. Now, in my prior rule, if the white line crossed the blue, which is the 20-day moving average, that's a pullback, and we would not buy stocks. But think of this, and this is part of the research I've been doing. Wouldn't this be a fabulous time to be adding stocks to our portfolio? I think so. Let's go back again. Here is a pullback, not a correction, just a pullback. Wouldn't this be a fantastic time to be adding stocks to our portfolio? So we're going to loosen up just a little bit the rules as to when I can and cannot buy stocks for you. During a pullback, if everything else, especially if everything else on the weekly chart looks strong, we will continue to buy stocks when we have cash available to buy stocks. But if it crosses into a correction, and a correction is when the blue, which is the 20-day, crosses below the gold, which is the 50-day, that's called a correction. In that case, no, we will not be buying any stocks because a correction is more severe. Corrections happen far less often than pullbacks. So little changes, but I think they're going to make a big difference. Let me go to stops, and then I'll show you my screeners and what I'm talking about there. So here's one of the stocks we're in. This is EXLS. And you see this little gold line down here? That is my stop. And you see the little alarm clock? That is my alert. So that's how all of my stops are going to work from now on. And you can see it went down almost to it, and then it bounced, came down. I thought we were going to be stopped out, but it didn't, and it bounced, came down yesterday, and then it closed a little bit higher. So what I'm trying to avoid is, let's say this one, which almost touched, could barely even see a space, that could have stopped us out of this stock, and then it can continue back up. And that's what I'm trying to avoid. Those are very aggravating when those happen. And so, again, I've got an alarm. It will let me know in multiple ways that there is a potential stop. And if at the end of the day, it actually does cross below that, then I'll go in, I'll put a negative 1% stop in the system live. If it goes down another 1%, we're out. But I'm giving it the opportunity to bounce back the next day. Okay, so I hope that kind of makes sense. Now let's go to the screeners for a second. I have a lot of screeners that I use, but I'm going to show you 3 of them that have been absolutely barn burner, wonderful screeners. And I've created all 3 of these. The first one is just called FCM Growth, and they all have names. I just make up names so I can understand what I'm looking for. But this one's called FCM Growth. Now, What I've done is I've put this on a chart looking back 1 year. So this is 12 months from today. Okay. And what you will see is this red line right here is in fact the S&P 500 over the last year. And this blue line here is my screener, my FCM growth screen, over the exact same period of time. And if we go up here, you'll see that the S&P is up 25% in the last year, which is an outstanding rate of return. But our FCM growth is up 116%, which is obviously better. If I add my second screener, I'm going to put this on and ask to compare it in the chart. This one I call large cap rockets. That's now the green line, same time frame. Here's the S&P 500. Here is the FCM growth. And here is the large cap rockets screen. That screen was up 193% over the last 12 months. Pretty strong, pretty strong. Let's add one more. I've got one that I'm looking for stocks that are beating both the market and their respective industries. It's a momentum system. Let's put that on. Bear with me, something just happened that was incorrect. Oh, let me take Apple out of here. And let's see, we've got large cap. I'm going to put growth back on. Okay, now we've got large cap and growth. And now I'm going to put the momentum on. There we go. Okay, so the S&P is down here. That's the S&P. This line right here, and you can see it highlighted, or I can even do it this way. That'll highlight it. This is the stock and momentum screen. This is the FCM growth screen in red. This is the large cap rockets screen in green. Now, what you might be saying to yourself is, well, then why do you should just use the large cap rocket screen because that has the best rate of return over 1 year. And it does. I can't argue that. But let's make some changes. Let's go to 6 months instead of 1 year, and let's see who wins. Over the last 6 months, the large cap rockets does great, but the other two aren't far behind. Over the last 3 months, the large cap rockets wins, but you can see that at different times, you see this cross right here. Sometimes this one is the momentum. Sometimes that does better than the FCM growth. And other times, let's go back to a 1 year. Other times the FCM growth, which is here, does better than that. So I'm going to buy stocks from all three of these screens because they actually do act just a little bit different. But all three of them significantly, I'm going to go back to 6 months to take a look at something, significantly outperform the market. I mean, the S&P over the last 6 months is up 8.6%. Large cap rockets is up 47. FCM growth is up, let's call it 39. Momentum is up again 39, about the same. These are very, very significant increases in rate of return. Okay, and I'll put the S&P 500 back on just so you can see. It's not showing the S&P 500 for some reason. Compared to, I don't know why, but it would be down. It would be down here. So what happens is every day I run these screens. Let's just go to the FCM growth, and it will give me a list of stocks that have passed my screening criteria. And I can see a lot of data on the stocks that are really important to me. And if I see something glaring that I really don't like, I'm going to skip that stock. So if this is not a black box, it's not blind. I'm still doing even more analysis on these stocks. If I go to large cap rockets right now, it's just got a few stocks in it. Sometimes it gives me 5 stocks. Sometimes it gives me 20 stocks. Just depends on the market. If I look at the momentum screen, I've got, looks like about 9 stocks. Sometimes it's as many as 20. And then I take all those stocks at the end of every day, and I come over here and I put them in this list. So that's all 3 screeners that I've just shown you, and I put them in a list. Now, This is today, and today was a good day, a strong day. Look at the returns. Let your eyes go up and look at the returns that this list of stocks did today. Now, let's look at the two that lost money. Apple only lost 0.2%. Netflix lost 0.64%. Here's something else that's interesting. Yesterday, Thursday, was a big down day for the market. It was just a down day for the market. And my list looked exactly the same. There were two or three losses, and the vast majority of stocks grew by pretty significant amounts. So that's the change. And like I said, I'm going to monitor this very closely, but I don't think that this change is going to make an incremental difference in rates of return. I think it has the potential to make a very significant difference in the rates of return, as we saw when we looked on the screeners compared to the S&P. It was like 4 times the difference. So between this and because I'm using a little bit smaller allocation, we'll have less risk per stock, per security. So that's good too. We're trying to increase our return by a significant amount and also lower our risk, which is very interesting and very hard to do. I will still be using all of my indicators, but I'm going to kind of release the perception that it has to be perfect. It just needs to have it can't have something on there that is glaring. If there's something that's glaring, if something is in a downtrend, I'm not buying it. I'm going to wait. I'm going to wait, but I'm trying to loosen that up a little bit. And I think it's going to create a very significant difference in what we see in returns. And again, without adding much more risk, potentially losing risk. Let me give you one example. EMA is a stock we made money on, and we got stopped out. We got stopped out right here, right there is where we were stopped out. And that stock has continued to go down. Okay. This has been so anytime during here, I would not have added this stock, even though this stock is on my screen. But look, it might be trying to change. And I'm not going to look for perfection. But if I see enough things change, little changes, I'm going to go back in and it's going to be one of the stocks. So I hope that makes sense. If it doesn't, or you want to dig deeper into this, just let me know. I did send out an email recently asking you to schedule a portfolio review. Please do that. I'll send out another email sometime next week for those of you who haven't already scheduled. Please schedule for a time that's convenient for you, and we'll go over your portfolio. We'll go over your performance reporting. We're going to go over a lot of things, and I think you'll find that helpful. Whether you have scheduled or not, if you have any questions about this new system, it's not a new system, the tweaks that I'm making to my systems, also feel free to go to my website, hop on that link that says schedule with Bruce, and you'll schedule a separate meeting just to talk about stocks. You can do that anytime you want. Anytime you want, you can hop on my calendar and we schedule a Zoom meeting. So I hope you will take advantage of that. That is the story. I think that these things are going to be rather interesting. Here's the front page of our website, by the way. And these are buttons. There's 2 buttons. This button, if you click it, will just take you to my schedule. And you can very easily hop on my schedule so we can have a chat about whatever we need to. But for now, we definitely need to do our annual reviews. So call me or email me if you have any questions. Don't forget, if you haven't done so already, to hop on and schedule a review so we can talk about your accounts. I have an interesting feeling that 2025 is going to be a very good year for us. And with this tweaking of some of these models that I've been testing for a year and they're proving themselves to be pretty awesome, I think we have the potential to make significant gains in our rates of return. So I want to leave it at that. I don't want to overpromise too much. That's the story. If you have any questions, let me know. Have a great weekend. I'm always around, and I will talk to you shortly. Bye-bye.